Hello, Stephen Koukoulas, Economist in residence for Zagga, and wow, we've had an interesting run of data over the last month since I last recorded a short video for you, and dare I say it, most of the data's been erring on the weak side. What we've actually seen is that the GDP numbers for the December quarter, which were just released, confirmed the economy only grew by 0.2% in the quarter, 1.5% for the year of 2023. So a clear step down in the rate of economic growth, and that's what you'd expect with the aggressive interest rate hikes from the RBA. So the slowing economy is happening. And for the early indicators into 2024, we've got things like building approvals, retail sales for January, job ads for January, February. They're weak as well. So expect this weakness to continue for the next quarter or two. In my view, we're going to remain relatively weak for the next 6 months. And that because of that, the unemployment rate will keep creeping up towards 4.5%. The good news is that inflation's coming down. So we know that inflation was only 3.4% in the year to January. Look, the month-on-month figures are very volatile. Things like petrol can have a really big effect on the short-run readings of on the inflation result. But basically, we've got the trifecta, if you like: slower growth, rising unemployment, and falling inflation. Now, this means that for the Reserve Bank, we're probably going to be talking more and more about the timing, magnitude of interest rate cuts. Look, it's a little early to be sort of too excited yet, but I think that trend through the course of this year towards lower interest rates will be apparent relatively soon. The Reserve Bank next meets on the 19th of March, so a little bit after when you see this for the first time. No change then. I think it's just a bit too early. But once we get to the 7th of May, they'll have another inflation reading, they'll have a bit more information on the labour market, and importantly, they'll know what's happening in the global economy, and that might just be the window opening, if you like, for the first rate cut in this cycle. If it's not then, it'll probably be the meeting after that. So in all this, I had been optimistic that we'd be seeing better dwelling construction numbers. That's disappointed the last couple of months. We've had building approvals tapering back down after a promising end to 2023. I think just the availability of labour, cost pressures, the interest rate hiking cycle are all feeding into a bit of what we call a double dip for the res construction part of the economy. The good news, I suppose, from that perspective, house prices are still resilient. There's still huge demand. Rental vacancy rates are low. So that question about when will the housing construction cycle pick up is still very relevant. The exact month and timing is unclear. But once we get to the second half of 2024, interest rate cuts, rising real wages, and income tax cuts that have been a hot political issue for the last couple of months will all feed to a better outlook. Look, great to be involved with Zagga, an absolute leader in its field. So look forward to chatting to you in real life in the not too distant future too. Thanks very much.